This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
Hello everyone. First of all, happy March Madness week to everybody. Today is the second day of the NCAA tournament. So for those of you who don't watch the tournament, you definitely should. It's a fun time. Last year, our kids all filled out their own brackets and they got really into it. So this year, we're watching a lot of the games. I'm excited later today. We're going to be watching some games together as a family. Always a good time. So I did fill out a couple brackets. I got Duke going all the way in one of my brackets and Florida in the other. So let me know down in the comment section down below if I am completely out of my mind or not. I think both those teams seem to have a pretty good chance to win it all. So last year, I did win the bracket challenge for our work. 2 leagues, won them both, so probably ran out of my good fortune on NCAA brackets for the next like 10 years last year. So anyways, hopefully this year we'll be back-to-back champs, but we'll see about that. With all the headlines that we've had about tariffs and the Fed and all that, I thought it would be interesting just to take a look at some of these headlines, some of the biggest headlines from the week. We're going to look at a couple earnings calls that can have a pretty big, almost like canary impact on the market. So we'll look at FedEx earnings and Nike's earnings. We're also going to look at the Fed decision. I'll give you a couple comments on that. Also going to look at gold and just see how good of an investment is gold in certain market environments. I don't do a ton of sponsors on this channel. I get a lot of inquiries, but I'm pretty picky about who I feature. I don't really want to associate with businesses or products that I would not personally buy myself. But in today's video, we do have a sponsor. It's a company called the Wheel Exchange. And I did recently get a new car. It's not really a new car, it's a new to me car. It's a used, well, I won't say what it was. If you want to check it out, you can check out the video if you want to see what car I bought. But it's a high mileage, 120,000 mile car. I feel like it was a pretty good deal, but you can be the judge of that. And anyways, I reached out to the Wheel Exchange about customizing the look of the car, the wheels. I personally chose the gloss black. The Wheel Exchange did offer me a free wheel exchange. I did pay for half the shipping. But if you're interested in customizing the look of your car for a lot less money than just buying wheels, I'll put a link in the description down below to my full review of the Wheel Exchange. Again, thank you to the Wheel Exchange for the free wheel exchange and for sponsoring this video. And I'm also going to make a little balance sheet here. So we're going to have the news items from the week that were in the positive category and then those that are in the negative category. And then at the end, we'll talk a little bit about the overall kind of balance of where the market stands at the moment. But we're going to first start off with a positive. The first positive and one that the market responded to very favorably was the Fed's decision to keep the federal funds rate unchanged. And probably most importantly, as far as the market's concerned, they still have 2 rate cuts planned for the end of the year. The Fed, just like everyone else, seems to be waiting on how the Trump administration's policies are likely to affect inflation and economic growth. There's a lot of uncertainty right now, but Fed policy is not one of them. And as a result, the market rallied a bit on the news. So we're going to put the Fed as a positive. I think it seems pretty clear that the Fed is going to do whatever it takes to support the economy should we get into a recessionary environment, or if inflation starts to tick up from tariffs, they'll likely continue to keep rates elevated, maybe not even cutting rates at all. So I think that still remains a bit of a downside risk. The Fed is currently on the positive side, but should they decide to keep rates neutral through the rest of the year and not cut them as the market expects, that will almost certainly be negative for the markets and likely result in rising interest rates. So currently the Fed is a positive, but it could easily turn to a negative should inflation start to kick up and they be forced to keep rates higher for longer. And this is some news actually from last week, but there was a couple cuts and one particularly notable in Wall Street analyst expectations for the year-end S&P 500 prices. Now, typically, I don't think analysts cutting their price targets really makes all that big of a difference. In fact, I typically tend to think of that as a bullish sign. If everyone is cutting their estimates, that's usually a good sign. But there's one particular analyst that I follow and admire, and that is economist Ed Yardeni. Yardeni has been consistently one of the most optimistic and bullish of all Wall Street analysts, of all economists. He had a best case S&P 500 target originally set to 7,000, but he reduced that to 6,400. He specifically called out stagflation as a concern. So we see here on the left, these were the Wall Street targets as of the start of the year. This is what they are at the moment. So you can see the majority of them remain unchanged. But there were two, Yardeni and Goldman Sachs, both reduced their estimates from 7,000 in Yardeni's case to 6,400. Goldman reduced it from 6,500 down to 6,200. So Goldman, now the most bearish of all these firms. I don't typically put a lot of emphasis on analyst estimates. In fact, I tend to think that analysts reducing their price targets tends to be a good thing for future returns. Ideally, the more bearish everyone is, the better future returns are likely to be. However, I'm going to put this one in the negative category, specifically because I really respect Yardeni. And since he's historically been very bullish, I find that his move to a little more bearishness is definitely cause for concern. I also think that there's not been too many that have reduced their expectations so far. So I think once we start to see a bunch of these start to be dropped, that tends to be a more positive sign. But since we're still in the early innings of this and potentially others starting to reduce theirs as well, all the uncertainty has been a negative for stock prices, but it's been a huge benefit. But gold has benefited significantly from the market's uncertainty. If you take a look at gold prices, they're actually up 15% for the year, and they just hit a new all-time high over $3,000. And typically gold does well when you have a lot of uncertainty, which we do now. Gold also tends to do well in an inflationary environment. So there's speculation that inflation may pick up with tariffs. That almost certainly benefits gold prices. And then you also have the Fed most likely to reduce interest rates as the year goes on. This article also made an interesting point, which I've not thought too much about before, and that is that gold becomes more attractive when interest rates are low. So the argument being, since gold does not have a yield like a stock would, or a dividend-paying stock would, or a bond would have, that means that if interest rates fall, the competition from those assets also gets lower, which benefits gold. I think this is a little bit conflicting, since rising inflation would tend to lead to rising rates by the Fed. So I think there's kind of a conflating possibilities there, but still a pretty interesting viewpoint, and definitely a notable sign to see gold performing so well. As to whether this is a positive or a negative, it's definitely a positive if you own gold, but probably a negative for stock prices. I think gold climbing so high indicates just how high uncertainty is. I'm not typically a huge fan of gold. It is a non-productive, pure speculative asset, meaning the only way you make money on gold is if someone else is willing to pay you more for it in the future. It doesn't generate any jobs. It doesn't generate any products. It's pure speculative. There's no other income that you can receive off of it. And that way, it's just like Bitcoin or just like any other currency. Anything that does not generate assets within itself or generate income is by nature speculative. But it was interesting reading through this article. It talks about how gold has performed in different market environments. The article points out that the last time we had a huge bout of inflation was between 1973 and 1979. So during that period, inflation was about 9% per year. Gold gained 35% annually between 73 and 79. And the last time we had inflation, not nearly as prolonged as it was in the 70s, but the 2021 to 2022 inflation bout. So when we had that, gold moved up in value by about 20%. So if we do end up with inflation picking up a little bit, which is what the gold market seems to be betting on, that could be a good performer. Just keep in mind that it can also reverse course pretty quickly. So this article talks about how after it hit its high at 2000, it lost 20% of the value through the next couple months to October. But if we get inflation and if we get a recession, it's likely that gold will outperform stock. According to this article, there have been 8 recessions since 1973 and 2020, and in 6 out of the 8, gold has outperformed the S&P 500. But perhaps one of the most bullish signs I think that we have right now is that the retail investor is extremely pessimistic. The American Association of Individual Investors does a survey, I believe it's weekly, where they interview different investors and they ask them, what is your outlook for stocks over the next 6-12 months? Is it bullish, is it neutral, or is it bearish? And typically the difference between bull-bear has been extremely predictive of future returns in the opposite way that you would probably imagine. So when more people are bearish, that tends to indicate a good future return, versus whenever most people are bullish, thinking stocks are going to go up in the future, that's when they typically go down. So this is kind of a contra-indicator. So currently, only 19% of those who responded to the survey think that stock prices are going to go up over the next 6 months. That is well below its historical average of 37%. It's also interesting, they note that this is the first time that ratio has been under 20% for 3 straight weeks. So people are exceptionally bearish at the moment, or at least according to that one, not bullish. Those who think the market is going to go down over the next 6 months was at 59%. So the average here is 31%. So it's been almost double what it typically is. Again, that is a good sign for the stock market. It's also been this low for 15 out of the last 17 weeks. And it's the first time that this sentiment has exceeded 57% bearish for 3 consecutive weeks. So if you take this spread, so the number of people that are bullish minus the number of people that are bearish, that has historically averaged about 6%. So a little bit more bullish than bearish, that's where it's been historically. That's currently negative 40%. That is wild. That's extremely low compared to their past observations. Again, that is a very good sign for stock. So I'm going to say retail bearishness, and that's probably worthy of at least 2 points if we're making a point scale. I think that's an extremely positive signal. On the negative side, we did have FedEx release their earnings today, actually, for Q3, and they're off 6.5%. And if we take a look at their stock chart over the last 12 months, you can see that they're down over 26% from their July 2024 high. And FedEx tends to be a very interesting earnings call to read and to listen to. Even if you're not interested in FedEx stock, they can be an indicator of how the economy is doing. Typically, the first thing you're going to see whenever people start to slow down their purchases, businesses or consumers, they're not going to ship as much. And according to FedEx's report, things don't look super great, specifically in the industrial area. So they talk about there's continued pressure in those business-to-business shipments. And they also cite how the current environment is adding uncertainty to demand. So naturally, businesses aren't going to be doing as much business-to-business transaction when there's so much uncertainty about tariffs and other things. If you might have a slowdown, businesses are going to be a little more hesitant, maybe delaying their purchases as much as possible, just until they get a little more clarity. They cited that multiple times, and here they gave some specific numbers. So in the freight division of their business, the industrial economy was a 5% decline in the average number of shipments, and then 3% decline in the weight per shipment. So there's less business-to-business activity overall, and they're shipping less. But that wasn't all they talked about. So they said their revenue expectations for Q4 and then their actual revenue that they reported for Q3 was less than they previously anticipated. However, they also talked about inflationary pressures on their cost. So both of those hit at the same time, and they reduced their full year outlook, hence the reduction in the stock's price despite their earnings being up 17%. That forward estimate was quite a bit more bearish than it was previously. So they reduced their expectation for their full year adjusted earnings from 19 to 20 down to 18 to 1860. So a fairly significant reduction in the earnings that they expect. And there was an interesting question by one of the analysts who asked them to give a little bit more detail on the inflation. And I thought his comment was fairly concerning for wage growth. So he says, with regard to inflation, it's been consistent. So you look at some of the factors that aren't going to go away. Inflation has been a constant. And also with regards to wages for employees. And he just says it's something that they're going to keep an eye on. He goes on to say later, we're going to try to contain that, but it's been a constant throughout. So higher wage inflation for FedEx may be an indicator that you're still seeing a lot of that wage pressure throughout the economy. One of the analysts specifically asked about recession and what they're seeing right now from the tariffs and how that's impacting their customers. And he made a really interesting point. He said he's not seeing a ton of pull forward. In other words, he's not seeing a lot of businesses go out and buy a bunch of inventory ahead of time and have that all shipped to them so they can avoid the tariffs. And he talks about why that's really hard. He says he's been sales calls with customers over the last 90 days, and he's only met one customer who attempted a pull forward buying a bunch of inventory ahead of time, and they regretted it. And the main reason is that they ended up storing some excess inventory. So in our current world where it's kind of like a just-in-time inventory where businesses don't want to have inventory just laying around that they have to store and maintain and all that, the customers just haven't made any major changes just because of how difficult it is to deal with that additional inventory. And he also talks about how difficult it is to move manufacturing. And that's one thing that's obviously relevant with tariffs. If we end up with prolonged tariffs on China, for example, it's not going to be overnight that these companies can just move their manufacturing from China to some other country. So as a result, he said that they're on the point where inflation is starting to hit the end customer. So the customers are either anticipating that they will increase prices or they already have. So inflation, at least according to FedEx, is either creeping its way into the economy as we speak, or it's planned to enter the economy over the next couple of months as businesses start to increase prices to offset these tariffs. So I definitely think the inflationary pressures are higher, not lower. And that's certainly something that I think the market would be concerned about and should be concerned about because it also affects Fed policy. So if inflation pressures are rising, that's going to impact the Fed and more likely push them over to the negative side than the positive side because they have no choice but to try to fight inflation. So I think this is a pretty big key. And if we start to see inflation bite, that's going to be a pretty bad deal for both the market in terms of stocks and the bond market, because you're likely to have the Fed not lower rates, which means higher rates in general. And Nike also reported their earnings and they're off 5.5% today. It's another one that tends to be a bellwether for the economy, but also they have a big presence in China, both in terms of revenues and also in terms of supplies. So it's interesting to see that over the last really couple of years, Nike stock price is off a staggering 60% from their highs. And I think Nike's a good lesson into why just because the stock price is down doesn't necessarily mean it's a good value or that it can't go lower. And I think you'll see what I mean whenever we look into Nike's actual earnings call. But there's a lot of negative momentum here for Nike, not just in terms of stock price, but also in terms of the business. So just look at these numbers. These are hideous numbers. So this quarter, revenues were down 9% on a reported basis. And if you adjust for currency, minus 7%. Their Nike Direct business was down 10%. Nike Digital declined 15%. And their Nike stores were down 2%. Wholesale was down 4%. And that was largely because of China. Their margins are also off. Gross margins down 330 basis points. That's 3.3%. Down to 41.5. So that's a pretty steep reduction in gross margins. They also talk about how they have higher markdowns on Nike Direct, so they're lowering prices. They've got bigger discounts on wholesale, and then they've also increased inventory obsolescence, meaning things that they've made, planning to sell, and they had to reduce prices or just get rid of them entirely because they're just not selling. And then they also talk about inventory. So we just saw this with the tariff discussion from FedEx that businesses don't want to accumulate excess inventory. That is a bad thing for business. It's particularly bad for Nike. We saw that in order to clear this inventory, they've got to reduce prices just to clear it. So they're saying that their inventory remains elevated across not just the US, but all geography. For the quarter, their earnings before interest and taxes were down 21%, but China was also pretty tough for them. Revenue down a staggering 15% in China. And just look at these numbers. Nike Direct down 11%, digital down 20, stores down 6, wholesale down 18%. And from China specifically, their operating income declined 42%. Traffic to stores is down double digits. And so the CEO talked a little bit about this China, kind of, are you going to get out of China, essentially? So they said in the call that they remain committed to China. They see a long-term opportunity in there. Mostly they're just seeing this kind of middle class, 1.3 billion consumers, that they think they can grow significantly in China, and that's going to be great for their business long term. And maybe that's the case, but so far that has not worked out well. Definitely over the last 2 or 3 years, and especially with the increased hostility from the Trump administration towards China. I don't know if this is still a great strategy, but he also talks about how he's not been over to China in a while, but he went over there. And he said the competition is a little bit more aggressive. But in CEO talk, they always, kind of like spin things a little bit, or they usually spin things. And so when he says the competition is a bit more aggressive, what he really means is that competition is way more aggressive than what he had remembered. And that was 4.5 years ago. So he's not been in China for 4.5 years. I find that troubling. If that's your business's biggest strategic move is to grow in China, and you haven't gone for 4.5 years, that just doesn't quite add up to me personally. But also that they're seeing a lot more competition, more aggressive than they thought. They've already got terrible numbers there. And clearly this administration is very anti-China. So I would not be surprised to see Nike continue to flounder. Maybe it's a good value. Maybe if you're a super long-term investor, I guess like I am, you might say, hey, Nike's still a great brand. I think it is a great brand. I just don't know that the strategic direction here, specifically in China, is a very good thing. And it doesn't sound to me like they're managing this particularly well. This was not at all a good earnings call. And I think when you couple that with FedEx and Nike together, both of those certainly aren't the entire economy, but both of them tend to be canaries in terms of business to business, consumer, business to consumer, shipping activity, and then also just kind of how retail is doing. Now, it could just be for Nike that they're on the wrong side of competition. So of all the earnings reports, I think reading into Nike for the entire economy would be a little bit more dangerous. But I do think it indicates that the consumer is a little more uncertain, specifically the consumer in China. So I just feel like any business that has large ties to China as a growth story is really kind of questionable at the moment. So when you add all this up together, it's pretty clear that we've got more on the side of negative than positive. We got 1, 2, 3, and then 4. Maybe gold's a little weak, so maybe it's really 3. I would give retail investors being bearish at least a couple points. So maybe you'd argue if we give retail, 2 points, the Fed 1, maybe it's a 3 to 4. But I do think inflation in particular is concerning, mostly because I think that can also kick the Fed over to negative territory. And if that's the case, I think we could pretty easily be in for a little more volatility as we finish 2025. It's hard for me to imagine that you've got a bear market unless you really do have a recession. Then I think a bear market is possible, but certainly a lot of uncertainty right now in the market. And we've seen that reflected, obviously, in stock prices. So let me know in the comment section what you think about the current market environment. Do you think the retail bearishness has gotten too far and that's presented a good buying opportunity? Or do you think the economy could be in for more trouble ahead? Love to hear your comments and get some discussion going down below. Also, let me know if you liked this format, the kind of talking about the news. Not done this before, so I'm just curious to get your thoughts on that as well. Thank you all so much for watching my channel, for all your support, and I look forward to seeing you in the next video.